Good afternoon, and welcome to McKonly and Asbury's first affordable housing webinar of 2021, which is Low-Income Housing Tax Credits 101. I'm Elizabeth Harriger, and I am a partner and director of affordable housing services here at McKonly and Asbury. And with me today is Josh Bantz, a principal at our firm, and he is also a leader in our affordable housing practice. McKonly and Asbury serves clients out of our 3 offices located in Camp Hill, Lancaster, and Bloomsburg. And in addition to our specialty in affordable housing services, we also provide a variety of other services as noted on our slide here. McKonly and Asbury has been specializing in affordable housing since the late 1980s. And we provide annual audits and tax preparation, as well as 10% tests, cost certifications, 50% tests, and a variety of consulting services related to low-income housing tax credits. You can learn more about us at our website, which is noted on the slide, and you can also follow us on Twitter, and the Twitter handle is also noted on the slide. We'd love to talk to you about how we can help you or how we could work with your organization. So feel free to reach out to us after the webinar or in the coming days and weeks. Our contact information is on our website and is also at the end of the presentation. Today's webinar is going to consist of 3 main areas. How to obtain the credits, or basically what happens before construction, what happens after construction that's specific to low-income housing tax credits, and then we're going to run through a few basic examples about how to calculate the credits. If you have questions, we welcome those, and you can submit them through the built-in questions function that's in the webinar control panel. And if you need CPE, there will be 3 polling questions during today's webinar. You'll need to answer all 3 of those polling questions. And if you need CPE, we will send CPE certificates within 2 weeks after the presentation. So let's start our webinar with our first polling question. How many low-income housing tax credit deals have you participated in developing? So is it 0? Have you never done a tax credit deal? Have you done maybe 1 to 3, or have you done 4 or more? So just select the radio button there. And again, you have to answer all 3 of these polling questions if you are looking for CPE credit. So Josh, how many tax credit deals do you think that you've looked at over the course of your time here at M&A?
I want to say 25 plus. I'm not sure if that's maybe a lot more than that, but I'm sitting here going back through probably the last 5 years, and it may just be 25 plus in those years. So
yeah, I would say I've definitely looked at dozens, if not hundreds. So it looks like our poll has closed, and the majority of our attendees today have not done any tax credit developing. 60% said 0, 14% said 1 to 3, and 26% said 4 or more. So that's a good mix. And again, since there are a number of people who haven't developed tax credits, if you have questions during the webinar, please feel free to put them in the question panel, and we'll try to answer them for you. So the tax credit program was created by the 1986 Tax Act. The credits are received over a 10-year period, and this is also called the credit period, as opposed to the compliance period. And I know those 2 things get confused and interchanged often, but the partnership will receive the credits over 10 years, and then they must remain in compliance for 15 years. So if you would get $1 million of credits allocated to your partnership, those credits would come to you over a 10-year period. So you would get $100,000 of credits per year. but then you still have to maintain compliance for another 5 years after that. And there are a number of compliance requirements that have to be met. So you want to make sure that you and your management company understand what those requirements are and the rules related to those. There is something called tax credit recapture if you are found to be out of compliance. There's also a 30-year, which is now changing to 35 years in Pennsylvania, a 30 to 35-year extended use period, which means that even if you sell the property, the partners exit the deal, this property has to be a low-income housing affordable property for 20 years. There are two types of tax credits, the 9% credit and the 4% credit. If you're doing a rehab deal or new construction deal, you would use the 9% rate, and your acquisition costs, if you are awarded acquisition credits, they come in at the 4% rate. Also, credits related to tax-exempt bond financing are at the 4% rate. And the credit is calculated based on the eligible basis of the property, which we will take a look at later in our presentation. So the people involved in a tax credit property, this typically doesn't change from development to development. You have the tax credit allocating state agency, which in Pennsylvania is PHFA. So you'll probably hear Josh and I use the TCAA and PHFA interchangeably, but that is the agency that allocates the tax credits for the state. There is the owner developer. Typically there's a housing consultant, but not always. Some larger developments have their own development crew on staff, so they don't need a housing consultant. There's an investor, and there is a contractor, an architect, a management agent, an attorney, and an accountant. And it's really important that the contractor, architect, management agent, attorney, and accountant understand Section 42 and low-income housing tax credits. You will make your life a lot easier if you surround yourself with a development team who are experts in the field. And if you're looking for an accountant, I would recommend McKonly and Asbury. So the ownership entity for these deals, the ownership entity of the affordable housing development is awarded the tax credits from the tax credit allocating agency, or in Pennsylvania, PHFA. And that ownership entity is typically a for-profit limited partnership. The limited partnership then sells those credits to investors who contribute money that's referred to as equity to the limited partnership. So I like to think of it as subsidized construction. Instead of the limited partnership having to take out millions of dollars of debt that then has to be repaid to fund the construction of these buildings, the partnership gets equity from the sale of the tax credits, which allows them to reduce the rents, since the money that's needed to fund the construction comes from that investor's equity rather than from cash flow that's generated from market rents to pay the debt service. So even though the rents are lower, a lot of times you'll hear like they're subsidized housing, and even though the rents are lower than market rate rents, they're still rent that has to be paid, and it's more of a subsidized construction process than it is having individuals with subsidized rent. So the typical funding mix for one of these partnerships, the investor equity is 75 to 85% of the sources of funds for these properties. And then there's what we call an equity gap that is typically filled with this soft financing, which can come from various sources. Some of the most popular that we see the most often are the Federal Home Loan Bank, the Department of Community and Economic Development, a local housing authority, Act 137 funds, And also we see this gap filled with a deferred developer fee. The developers can earn a fee of up to $1.5 million on each one of these deals, and they can use a percentage of that to fund the gap between the total cost of the building and the investor equity. Tax-exempt financing is also a source of funds for these properties. That would be a webinar all onto itself. They're pretty complicated deals, but they do receive an automatic receipt of, or they do receive an automatic allocation of 4% credits without having to compete, without having to submit a tax credit application for a competitive funding round. But they do have to fill out an application, and they have to meet certain threshold criteria to get those credits. It's just they don't need to compete for them against other developers who are also looking for tax credits. So our webinar is going to focus on the following areas of the tax credit process: identifying an area with a need for affordable housing, property identification, submitting a tax credit to the TCAA, receiving a reservation of tax credits from the TCAA, executing a carryover allocation, the equity closing, starting construction, performing and passing the 10% test, construction completion, the development cost certification, and the 8609s being issued. The first step in the process is to identify an area with a need for affordable housing. So is there a need? Is there community support? I don't know if you've heard the term NIMBYism, or NIMBY, which stands for not in my backyard. We hear about this just far too often, about communities opposing affordable housing or tax credit housing being developed in their area. So community support is huge. Political support, tenant population interest. I mean, you can build a great apartment building, but you need to have people who want to live there. Is the building compatible with surrounding uses? Is it consistent with local growth planning? Every once in a while, there'll be an area that their local plan will talk about the need for additional affordable housing. And that's something that's great to be able to include with your tax credit application. Are there economic benefits to the residents and or the surrounding area? And, you know, what are the neighborhood characteristics? If you have a family property, are there good schools nearby? Are there good healthcare facilities? What's the transportation like? Is there a bus stop nearby? What's the walkability? Can you easily walk to stores or schools or healthcare facilities? All things to consider. And then the next step is to identify a property. So you can either purchase a property or you can use a long-term land lease. You can just buy vacant land. You can buy a vacant building. You can buy an existing residential building. You'll want to look at the community impact. Like, is it a good fit for the community? And do you want to do a mixed use property? Would that fit in well to where you want to build? That would mean, do you want to mix in some market rate units with your low income units? And it's really interesting to me, some of the places that we've seen be transformed into affordable housing. The first place that I remember going was to an old school building that was transformed into affordable housing, and going to a grand opening and meeting the residents, and just how proud they were to live there. And they called their apartments their rooms, and they called the entire building their house. So that was my first exposure to people living in affordable housing. And I think I knew then that this was a great industry and something that I wanted to be a part of. So it's been neat to see the different the different buildings that have been transformed, and just amazing to me that the buildings that have been built on vacant land and just how phenomenal those buildings and these properties are.
I couldn't agree more, Elizabeth. The first one I went to, I believe, was an old warehouse that was converted, that had basically almost fallen in and converted to a building, and it was full of residents who were just thrilled with the location and the result of the property.
Yeah, it's funny when I'm driving somewhere with my family, I'll just say, and I see a building, I'll say, that looks like it could be affordable housing. I wonder if there's a zoning problem. I wonder if anybody's thought of that. So the next step is, after you've identified an area with a need and the location for your property, you need to submit a tax credit application. And this is no small undertaking. If you don't have experience with this, you will want to hire a consultant who does, because there's just a number of things to be navigated through this. They're several inches thick, full of paper that needs to be collected and compiled, and it's a big undertaking, but it also creates a great product. So some things to consider with the tax credit application. Each state has a qualified allocation plan, and you can read Pennsylvania's on PHFA's website, and it discusses preferences and set-asides to meet the tax credit allocating agency's goals, whether it's Pennsylvania, Delaware, New Jersey, Maryland, any state will have a qualified allocation plan, and you're going to want to look at that and see, like, what kind of housing are they really preferring at this time. There's also ranking criteria in the tax credit application, and that's how your application will be selected. You will fill out a self-scoring sheet, and the agency, the TCAA, will also score it. So you want to be as realistic as possible in your self-scoring, so that you really know, are there areas that you could really beef up. And those ranking criteria in the recent 2021 application for PHFA have categories such as community and economic impact, mixed income properties. You can get points if it's more than 15% market rate, but less than 25%. You get points for energy efficiency and green building. The experience of the development team can get you points, and development cost savings. Those are just a few, or a handful of the categories. So when you're looking to develop, you're going to want to make sure you look at the scoring criteria and make sure what you want to build is in line with what the state agency is looking for. And then you'll also need to include a market study, an appraisal, a phase 1 environmental study, and architectural plans. And these things aren't necessarily inexpensive. So it's costly to put one of these applications together. You can recoup the cost if you're funded, but just be aware that there is a pretty significant cash outlay to start. You also need to have your development team together for your application. They'll all need to be included in there. You'll need a financial projection. You'll need a construction cost estimate to help build your development budget. You'll need to have a letter of intent from an equity partner, and the ranking criteria that we just talked about is key to these applications. So as I mentioned, the TCAA scores the applications, and then the top ranked applications will receive the credits. And generally, a development must be placed in service in the year that the tax credits are awarded by the agency. But that, I've never seen that happen. If you get the awards, even if you get the awards in April or May, I've just never seen a building be completed by December 31st. So in order to extend that, you can execute what's called a carryover allocation agreement. And this agreement can extend the placed in service date to the end of the second calendar year after the year that the carryover allocation is made. So basically, you can extend it for 2 years after the year that you get your tax credit award. And sometimes I've seen properties more than once have trouble even being placed in service with the additional time. You just never know what you might run into as far as construction goes on these deals and what the timing could be. So there's a few closings that can happen. Obviously, the property acquisition would be a closing when you obtain ownership of the property. If sometimes we see a closing for financing for various loans coming into the partnership, and then there'll be the equity closing where the limited partnership agreement is executed and funds come into the property. So polling question number 2, what do you consider to be the most challenging part of developing tax credit properties? Is it the application process? Is it the construction? Or is it maintaining compliance after the building is occupied? So that question is probably more for our folks who have developed at least one property, but even if you haven't, just give a guess on which part of the process you think would be most challenging.
This should be interesting to see what everybody's answers are related to this, because I think there's challenging parts in all aspects of these 3 items.
Yes, we always hear it said that developing a tax credit property is not for the faint of heart. So interesting, the application process is the most difficult. And construction is the easiest, and maintaining compliance after the building is occupied. That's interesting. Yeah, putting this application together is not easy. That's for sure, but it is fun.
All right, good afternoon, everybody. I'm going to continue through the rest of the development process with you and kind of give you some examples and so forth as we continue to move through the tax credit process. So the next step after closing would be to start the construction process. And as part of the construction process, sometimes it doesn't, the construction hasn't started, but the 10% test is next. And basically, the 10% test is a rule that is required to be, that requires the property to have 10% of reasonably expected basis must be incurred no later than 1 year after the project receives its low-income housing tax credit reservation. So, the idea here is that the tax credit agency wants to ensure that the project is feasible and is continuing down the line of being built, whether it's being built or continuing down the line of being of progressing. So therefore, they require this test just to ensure that the reservation still is still good for the amount of credits that they have. And the project must receive the carryover allocation agreement, which is also part of this, and satisfy the 10% test upon the required time frame issued by the state allocating agency. So every state can be different in this one, and not only that, but each qualified allocation plan issued by the state can have different time frames on it. So the 10% test does require a CPA certification, so it's an examination that is done of the costs that have been incurred at the date of the 10% test, and a calculation of the reasonably expected basis to ensure that 10% of the reasonably expected basis has been incurred. So you will be required to get a 10% test if you have a tax credit reservation, and a CPA firm will be required to do the certification.
And just a quick explanation of reasonably expected basis, that would be land and all depreciable costs.
Correct.
So you need to incur at least 10% of your land and your depreciable costs in the allocated time frame to pass this test.
Correct. Yeah, the definition and the calculation for reasonably expected basis is land plus other depreciable, any other depreciable costs. Next is the construction phase. So, I think 10% tests can happen prior to construction occurring. It can also happen in the middle of construction, depending on the time frame and when the tax credit reservation was. But the average construction period that we typically see for a low-income housing tax credit project is usually around 9 to 18 months. Just from the time of initial closing through certificate of occupancy in the building is completed and ready to have residents moved in. Typically, the investor equity is paid using draw requests throughout the construction period. So an example could be very simply that if it's a 10-month construction period, typically there's monthly draws, and then there'll be two to five draws that occur after, typically after construction is completed, to kind of wrap up the construction costs. That being said, there's also instances where there's bridge financing that is used from initial closing through the end of construction, which allows the equity investor to invest their funds a little later in the process, which helps a better return on investment for the typical investor. So and typically, most of these properties, they try to do the construction through the summer months to the extent possible. Obviously, at least in our area here in Pennsylvania, doing construction in the middle of winter or starting construction when the ground is frozen isn't usually the greatest thing. So typically, like to see an early spring closing and then a summer construction period that ramps up with a completion towards the end of the year and early into the next year. At construction completion, once construction is complete, the contractor has completed everything. The big key to the construction completion is what we have written there, which is a certificate of occupancy. The certificate of occupancy is issued, and it allows for tenants to begin to be able to move into the property. So it allows for occupancy of the property. At that point, the certificate of occupancy is issued. There's a cost certification deadline typically set, by the state agency, which allows, it's based on the last building that was placed in service, and it may be in Pennsylvania, for example, it's 90 days from the date of the last building placed in service. Other states have varying timeframes, but typically that certificate of occupancy starts the clock for that process. So, during, when you get your certificate of occupancy, as you're starting into the cost certification process, so you kind of want to be aware of deadlines and due dates and so forth. Also, at certificate of occupancy, lease up of the property begins. It's a time when the property can begin to have tenants move in. Hopefully in most cases, most properties kind of have a list of potential tenants and have done some of the work before the certificate of occupancy is even issued, so they can start moving individuals in upon that construction completion date. All right, as I just stated in the last slide, the cost certification starts once the certificate of occupancy is issued. The cost cert process begins in a time, and the clock starts ticking, so to speak, on the cost certification. So what is a development cost certification, and why is one necessary? So effectively, a cost certification is a certification of the eligible basis for the costs that were required to build the building or build the property. It could be multiple buildings. So the idea behind that is you'll see in future slides, the tax credits are driven off of a percentage of eligible basis. Well, how do you know the eligible basis is correct? This is where a cost certification comes in, and with a cost certification, a CPA firm comes in, like McKonly and Asbury, and actually certifies the costs that were required to build the building. You'll have costs in a cost certification, like construction costs from the contractor, as well as soft costs, architect fees, engineering, development fee, so forth. So there's each tax credit, state agency has their own cost certification kind of template, or how they expect to see it. I mean, they all are calculating what the eligible basis is, because that's the IRS role, is to calculate the tax credits based on the eligible basis. But they all have their own kind of template that they use, or required format that they use. So they won't all necessarily look the same, but they're all effectively doing the same thing, which is calculating eligible basis and having a CPA certify through an examination and attestation that eligible basis is accurate. After the cost certification has been completed and issued, and there's a defined, the basis is determined and the calculation for the tax credits is determined. The tax credit, the state agency will issue a IRS form 8609, which is effectively the IRS form that essentially has the eligible basis on, for the eligible basis for the building for low-income housing tax credits. One thing to note, each building gets their own 8609. So typically state agencies issue bin numbers, and the bin number then is what goes on to the 8609, and each building is allocated a portion of the eligible basis. The 8609 has a part 1 that's typically filled out by the state agency, and then the 8609 has a part 2, which is to be completed and signed by the owner. And then the 8609s are filed with the state agency or the IRS clearinghouse, if required, the state agency as well. So depending on what state you're in, at a minimum, you're filing it with the IRS. It's kind of what I would call your kind of tax credit ticket, so to speak, that tells you exactly how much tax credits your building is going to be getting over the next 10 years. So that's kind of a key component. It has to be filed with the IRS clearinghouse.
Yeah, the 8609 is the golden ticket, as
Yes.
as Josh was referring to. Whenever we find out that a client has received them, we're very excited. And we recommend that you have part 2 at least reviewed by an accountant who understands tax credits, if not completed by an accountant.
Correct. As we said, the part 2 is to be completed and signed by the owner, but certainly, as I pulled up here, an example of the 8609, some of the questions on part 2 are, can be a little confusing to somebody who's not familiar with filling them out. So it's certainly at a minimum, if you are going to fill it out, you should have your CPA review it. And, if needed, you can have your CPA fill it out too, especially if they perform the cost certification and so forth. It's certainly something that is, they're much more familiar with completing and tend to do it on a regular basis. But here's what the Form 8609 looks like. Effectively, it just breaks down the allocation of credits by building, the date of the allocation, how much were allocated to the building, and so forth. So, it's as Elizabeth said, the golden ticket. I mean, this is what allows a low-income housing tax credit property to be able to actually receive the tax credits. So now we'll kind of dive in here to calculating the tax credits. And we talked about the cost certification, and we talked about the construction and the whole process leading through, tax credit application, through 10% test, through all the closings, et cetera. So now we're going to get into a little detailed discussion on how you actually calculate low-income housing tax credits. So, the amount of the credits are actually based upon the cost of construction or rehabilitation, as well as the percentage of qualified low-income housing units, and then the tax credit percentage. So there's a couple of variables there. As we go through this, you'll kind of detail, what the actual cost, how you actually calculate the cost of construction and rehabilitation, what goes into that, and then we'll get into an example of, what the percentage of qualified low-income units means. And we kind of call that the applicable fraction. But and then last, we'll get into the tax credit percentage, because certainly each of these 3 items contributes in some perspective to the calculation and how much tax credits you get. So I don't think we want to glance over any specific one, so to speak. So,
Josh, can I just interrupt for a minute? Absolutely. We did get a question about the 8609s. The question is, why does it take so long to receive the approved 8609? It can take years. Is the holdup at the IRS or at PHFA? The holdup is at PHFA. I can't really answer why it's taking so long, but it's a known issue. PHFA is aware of it. And it's my understanding that they are working to address the issue to speed up the process.
Great. And just to clarify, the initial 8609 is issued by the state agency. So the IRS does not just receives the copy of the completed 8609 Part 1 and Part 2. So hopefully that makes that a little clear. So diving back into calculating the tax credits. So eligible basis is, includes most depreciable costs. And what we're going to get into here with eligible basis is kind of the discussion of what items go into calculating the tax credits. So it includes depreciable costs. Most depreciable costs, there's occasionally some specific depreciable costs that are excluded from that calculation of eligible basis, though that is typically very small. So it includes most depreciable costs. So as I like to say, kind of your sticks and bricks, so to speak, your construction contract costs, and then other depreciable costs would be soft costs. There's a long laundry list of soft costs, but we can start with architect design, architect supervision, and keep going into engineering, et cetera, municipal tap-in fees and so forth. So those are your soft costs, construction costs that are required outside of kind of the construction contract. No, eligible basis does not include, because it's not depreciable, land and any associated costs with land, such as closing costs, et cetera. Any off-site improvements, so any improvements that are required to be done that aren't on the actual site. Sometimes there's roads and varying sidewalks and things that may be required as part of township permitting. Building demo. Yeah.
Just to go back to that, there are cases of off-site where you just suggested where it's required by the township. If it's required to get a certificate of occupancy, it's quite possible that it could be basis eligible. But in general, Josh is correct.
Yeah.
Josh, you're correct that off-site improvements are not basis eligible. It would just be if they are required to have the township issue the certificate of occupancy.
That is correct. No, and we don't see a ton of offsite improvements, but occasionally there's something with a parking lot or something like that that comes up where it can certainly impact it. Building demolition is typically excluded. Tax credit fees that are paid to the state agency, as well as rent up and permanent financing fees. These are all fees that are part of the cost certification, but they're not depreciable. So therefore they are excluded from calculating the credits. Eligible basis also excludes several other things. One is reserves. Typically you'll see, the requirement in the budget and the requirement to fund specific reserves, whether it be an operating reserve or a supportive services reserve. Those are not included in the eligible basis, nor are organizational fees, syndication fees, compliance monitoring fees, or any relocation costs. Specifically, if you have a building that is currently occupied and you're rehabbing units and moving people in and out, relocation costs are not includable in basis. So the next aspect of calculating, once you've kind of defined your eligible basis, there's a specific boost that can be, we call it a high cost area or a basis boost. When you have your total eligible basis, if you're in a difficult to develop area or a qualified census tract, you can receive up to 130% basis boost, which essentially takes whatever your eligible basis is times 130%. So if you have $10 million in eligible basis to calculate your tax credits, and you have a 130% basis boost, now you're looking at $13 million in eligible basis. So just given that you get an extra 30% added to your basis. So I will say that, it's difficult to develop area and qualified census tract are part of it, but also it's the state agency's decision on the basis. So it doesn't necessarily have to be, and I will speak to this very clearly, you may not get an entire 130% basis boost if, the state agency determines that the area that you're working in or whatever the needs may be, they may give you a boost to 110%, 112%. It's kind of at their discretion and the state agency's decision, and it typically happens in the underwriting process before, well before you get to the point of calculating the tax credits, at close, after closing and after construction and on a cost certification. So it would be something that would be calculated in the initial phases and be worked out at that point. So, so basically that gives you a specific, boost that allows you to get more tax credits than your initial eligible basis. The next aspect that plays a role in calculating the tax credits is the applicable fraction. So the applicable fraction is the percentage of the building that is treated as low income. It's a lesser of the unit fraction or the floor space fraction. So effectively, if a building has 50 units, just to kind of break this down very clearly, if a building has 50 units, and all 50 are low income units, then the applicable fraction will be 100%. Typically, if there's a mix of low income units and market rate units, then your applicable fraction is calculated based on the lesser of the unit fraction, which I will define the unit fraction as, if there's 40 units that are low income out of 50, 40 divided by 50 gives you the unit fraction. The floor space fraction is the square footage of those 40 units versus the total square footage. So it's the lesser of those two fractions to calculate that. And I actually kind of delved into that already and gave my example, but in a unit fraction example of 50 low income units out of 60 total units. So in that case, we would be looking at 10 market rate units. The floor space unit fraction would be 83%. In that same example that we have there, the floor space fraction, which is square footage floor space, 60,000 square feet of low income square footage and 70,000 of total square footage, which implies that there's 10,000 of market rate square footage, results in a floor space fraction of 86%. So in that instance, when we look at the applicable fraction, you would use the lesser of those two. The credit percentage the applicable fraction is effectively taking the eligible, the basis that has been calculated, whether there's a boost or not a boost, times that percentage to kind of come up with the actual percentage of basis that's going to be calculating tax credits. So effectively, this applicable fraction percentage is, one of the additional components beyond just your eligible basis for developing the tax credits. So if it's an all low income project, 100%, fairly easy. If it's got a mix of market and low income units, then it's going to be your lesser of unit fraction or lesser of floor square footage fraction.
So then that applicable percentage there is the credit percentage that a qualified low income development would be eligible for, which Josh talked about all the way down through the applicable fraction. Then after you take the basis that you have times the applicable fraction that he just explained, you would multiply that by the applicable percentage, which would either be the 9% rate or the 4% rate that we touched on earlier. If it's rehab, new construction, it'll be the 9%. If it is a tax exempt bond finance deal or your acquisition credits, it would be the 4% rate.
That is absolutely correct. I think I got my applicables confused a little bit too, so I was reading that, but no, the applicable percentage is the tax credit percentage that you're going to take your basis by. So I brought up an example. So I know we're talking through this, and a lot of us, I for one am very visual. So, let's take a look at an example here, and I'll kind of point out to you as I'm looking at this example what these specific areas that we just talked about were. So the eligible basis in this example, which we talked about, is that typically the depreciable basis is $8 million. So we talked about calculating that eligible basis, and you're looking at the depreciable basis of items. Now, we talked about the 130% basis boost. In this example, there is no 100% basis boost. It's not a high cost. It says high cost area. It's 100%. So there's no boost. So the total eligible basis for this project would be, this property would be $8 million. The applicable fraction, which we talked about, is the unit square footage, or the unit fraction is 100%. So in this particular example, we're looking specifically at a property that has all low income units. So when you take your eligible basis times your applicable fraction, you get qualified basis of $8 million. Now, we talked just briefly there. The last thing we talked about was the applicable tax credit percentage. This is how you determine how much tax credits the actual property qualifies for. So at 9% rehab credit, you take your qualified basis times your $9 million, and you've qualified for a maximum credit of $720,000. So as you can see, high cost area, we work with eligible basis, high cost area, yes, no, what is the boost? We get to an total eligible basis, determine our applicable fraction, multiply that times the qualified basis, and then times the applicable percentage to get your maximum credits qualified for. So in this example, the property has qualified for $720,000 in tax credits per year times 10 years. So the total credits that this property will receive is 7.2 million in total tax credits. The limited partner, as we were talking, the structure of the deals, the limited partners percentage is typically 99.99%. It's not every deal, but a lot of them, that's where it resides. So, the limited partner will get, the investor limited partner will receive in that 10 years, 7,199,000 and change of tax credits flowing back to it. So now we kind of get into the equity pay-in rate. So one of the things we discuss is the structure of how these deals are put together. And one of the aspects is we talk about the investor equity. And, if the investor is going to get 7,199,000 and change of tax credits, and they agree to pay in at a rate of 95 cents for each dollar of tax credits, that limited partner then will invest to build the property $6.8 million, almost $6.85 million of equity. That's just based on the calculation. So as you can see, this kind of shows the flow of tax credits being awarded in a specific amount for 10 years to get the total amount multiplied by the partnership, the limited partner percentage. Total credits to the limited partner times the pay-in rate gets you how much equity that a 720 a property that's been awarded $720,000 a year in tax credits will receive back to help build the property. Example 2 is going to have a high cost basis boost. So in this case, same details, except as you can see, the high cost area is the 130%. So that boosts the eligible basis from 8 million up to 10.4. Applicable fraction stays the same. The qualified basis of this same property with the boost is now 10,400,000, 9% applicable percentage of the tax credit percentage. So now you're looking at maximum credits of 900,000, 936,000. So as you can see, same example, high cost area generates more tax credits, just given that that's what the 130% basis boost effectively does. In this same example, now we'll see how this also generates more equity to the partnership to kind of close the gap, as we talked earlier about the mix between equity and financing. Elizabeth talked about that in the beginning, but the tax credit it's awarded is 936,000, 10 years. Total credits are 9,360,000, 99% of that, 95%. This equity generated is actually 8,800,000, almost $8,900,000 in equity versus the previous example, which was without the basis boost, which was $6.8 million in equity. So as you can see, the basis boost matters. It generates a lot more equity, particularly so there's an incentive there to develop hard to develop areas and qualified census tracts. We're going to go to example 3, which in this case is the same example. Only thing we're going to change is the high cost area will stay at 100%, but we talked about the applicable fraction, unit floor space, or unit fraction. In this case, we went into the example earlier where it was 50 low income units out of 60 total units. So as you can see, your total eligible basis is 8 million. Your applicable fraction in this case is 83%, which will impact what your actual qualified basis is to calculate your tax credits. So, from 8 million down to, the qualified basis now is not 8 million, it's 6,640,000. 9% of that generates tax credits of $597,000. So as you can see, the applicable fraction generates less tax credits because you can't earn tax credits on the 10 units that are market rate units. And as we have kind of gone through these examples before, the same situation exists here with with how you calculate the limited partner's equity and the total tax credits over 10 years, 99%, 95% pay-in rate. In this case, it's going to generate $5.6 million of almost $5.7 million of LP equity. So one of the things that I kind of take from this is you can see how the changes to the fraction, to the applicable fraction, the changes to the basis boost really can generate equity, limited partner equity to build the property that is, vastly different. I mean, we've seen 5 million, we've seen, almost 8.9 million, and then we've also seen the initial with no basis boost of 6.8 million. So really, these fractions and these amounts are all, have fairly substantial implications on how much tax credits you'll receive and how much tax credits the limited partner would be willing to put in equity. So now we've got polling question number 3. Hopefully I didn't put anybody to sleep with all those examples. So polling question number 3, what is your favorite summertime activity? And I have about 30 seconds to answer this now. So Elizabeth, what's your favorite? I was just going to ask you the same question. My favorite summertime activity is probably outdoor hiking, biking. I'm not a big biker, but hiking and other outdoor sports. So
okay, I like reading on the porch.
It is very relaxing. I will say
my favorite wintertime activity would be reading on the couch.
It's a little more difficult for me to be able to enjoy wintertime activities that are outside just because it's cold. So it's not nearly as enjoyable. So,
going to the beach is a big one.
Yes, I was just going to say the overwhelming response to this appears to be going to the beach, where everybody is 51% of folks' favorite summertime activity is going to the beach.
So hopefully everybody could take something away from today's webinar. There were no additional questions that came in, so if you think of anything, you can feel free to email either Josh or myself. We'd be happy to correspond with you and try to help you along. And there will be a recording of today's presentation posted to our website and social media sites within the next few days. And if you need the CPE credit and you answer the polling questions, those certificates will be sent out in the next couple of weeks. And you can mark your calendars now for October 27th for our fall webinar, which will feature AJ Johnson. We don't have the topics quite pulled together yet, but we know AJ is going to be our presenter, and he is always great. So thanks, Josh, for helping out, and thanks to everybody for joining us today. And we hope to see you on a future webinar.